When traders deal with multi-asset options, the first thing they don't look at is price or strike. They look at one hidden factor called correlation, because correlation quietly decides how big or small the option payoff can become. It tells us how two assets move relative to each other. If both stocks move together, the opportunity is small. But if they move differently, the gaps become bigger in option, profits grow. So in simple words, correlation is the engine that drives every multi-asset option's value. Now imagine you hold an option that pays you the higher price between two stocks. This is called an option on the maximum. And here you simply pick the winner of the race. Whichever stock finishes higher becomes your payoff. So if stock 1 is 120 and stock 2 is 100, you get 120. And if stock 2 jumps to 140, you take 140. And because low correlation increases the chance that one stock strongly outperforms the other, this option becomes more valuable. Next comes the basket or portfolio option, where instead of choosing one winner, you combine both stocks into a single bundle using weights, like half of stock 1 and half of stock 2. And the payoff depends on their average minus the strike price. So this behaves like teamwork, where gains in one stock can offset losses in another, which reduces risk, but if both stocks are highly correlated, they move together and diversification disappears, making the basket less exciting. Then we have spread or exchange options, which focus purely on the difference between two stocks. Here, the payoff is max of 0 or stock 2 minus stock 1. So you only earn when one clearly beats the other. It's like swapping a slow bike for a faster one. For example, if stock 1 is 90 and stock 2 is 110, you gain 20. But if both are equal, you gain nothing. And again, lower correlation creates bigger differences, which means bigger profits. All of this shows why correlation directly affects option prices. Because when correlation is high, both assets move together and spreads stay tight, so option value falls. But when correlation is low, prices diverge more, spreads widen, volatility rises, and option prices increase, which is exactly what traders want. Finally, the math also confirms this idea through the exchange option volatility formula. Sigma equals square root of sigma 1 square plus sigma 2 square minus 2 rho sigma 1 sigma 2. And when correlation rho falls, that negative term becomes smaller. Total volatility rises, and higher volatility means higher option premium. So the simple takeaway is that multi-asset options love differences, they love gaps, and they love low correlation, because bigger separation between assets directly creates bigger potential payoffs and higher prices.